Good evening and welcome. Onyx Corporation is Canada's only publicly traded private equity firm. And although its business model is similar to those of KKR and Blackstone, Onyx generates a greater proportion of income from returns from its proprietary capital. This key differentiator provides investors in Onyx common shares with unique exposure to private equity through an investment in public markets. We initiate coverage in Onyx Corporation with a buy recommendation at a 12-month target price of $44 per share. There are four main drivers of our buy recommendation. 1, Onyx's management team. 2, favorable economic conditions. 3, Onyx's growing asset management business. And 4, our quantitative valuation, suggesting a 20% upside from the current market price. In analyzing these four drivers and addressing associated investment risks, we arrive at our final buy recommendation. These components make up the agenda for the rest of the presentation. We'll now take a closer look at driver 1, Onyx's management. Since inception, Onyx's management team, led by Jerry Schwartz, has achieved investment performance that rivals global private equity leaders, as shown by a 29% IRR on realized and publicly traded investments, and a 3.3 times multiple of capital, reflecting Onyx's ability to turn good companies into great ones. But most importantly to shareholders, management's investment ability translates to share price performance, as seen when we compare Onyx against the broad market in gray and an index of publicly traded private equity firms in red. Onyx's common shares have generated 17% compound annual growth since inception. Management's impressive track record is due in part to its extensive network of well-connected executives. Behind me are the logos of various organizations, public, private, and not-for-profit, that Onyx currently has a board presence on. This extensive network aids Onyx in raising future funds, executing takeovers, and negotiating favorable financing for its operating companies. Now, management's ability is only of value to shareholders if proper controls are in place to align management's efforts with shareholders' interests. One mechanism designed to achieve this is the management investment plan, which requires that 25% of distributions to management be reinvested in Onyx common stock. Because of this, management is the largest holder of Onyx shares with approximately 23%. Further, Onyx Corporation is the largest LP investor in each of its funds, fully aligning management with the corporation and the corporation with the funds. Management's average of 16 years experience with Onyx is empirical proof that these controls are also effective in retaining top talent. I'd now like to pass it along to Michael to discuss driver 2, the economic environment.
Currently, there's a great deal of uncertainty due to the European sovereign debt crisis, as evidenced by recent volatility of yield spreads. As a result, Onyx's operating companies may find it challenging to obtain financing. However, Onyx has less exposure in comparison to competitors because it focuses primarily on operational improvement while using less leverage and acquiring targets at lower multiples in comparison to industry standards. Furthermore, Onyx does not have significant refinancing requirements within the near term. We believe these factors should allow Onyx to perform well despite the uncertainty in the markets. In fact, Onyx's track record reveals that despite lagging competitors in some instances, Onyx outperformed the market and its peers both during and after the most recent recession. Given the current uncertainty in the markets, we believe Onyx's past experience may give it a competitive edge over others in the industry. Onyx's performance is also dependent on the U.S. manufacturing sector, because the majority of their holdings are in manufacturing, and over 2/3 of their revenues originate from North America. Now, what does this mean? If you look at the U.S. manufacturing sector, we see that there are signs that it may be poised for a recovery. In fact, there are already signs of improvement in the PMI index, a leading indicator of U.S. manufacturing output. Given Onyx's portfolio composition, we believe that they are properly leveraged to benefit from this trend through an increase in the NAV. But more importantly, what does that mean for shareholders? If you look at the graph, you'll notice that growth in market cap is largely driven by growth in NAV. Therefore, with an improving U.S. manufacturing sector which will drive NAV growth for Onyx, it should in turn drive shareholder value in the upcoming year. Next, I'd like to pass it on to Michael to discuss driver number 3, the asset management business.
We believe the asset management business will continue to grow and create value for shareholders. A key driver of the growth in assets under management is increased institutional allocation. Currently, Onyx's main source of funding comes from large pension plans. These plans are faced with a growing asset and liability gap due to a low interest rate environment. This creates an incentive for them to invest in higher yielding asset classes, such as private equity. However, 58% of institutions are actually below their targeted PE allocations. This suggests that there's significant room for them to increase their PE allocation, which we believe will create a favorable fundraising environment for private equity firms like Onyx. This also coincides with a growing preference for specialized industry funds. Large pension plans often have in-house private equity groups. However, they lack in-depth knowledge of specialized industries. We believe Onyx can leverage its knowledge of industries such as aerospace, managed healthcare, or building products to capture this growing share of institutional allocation. Overall, Onyx is well positioned to grow its assets under management. Historically, Onyx has grown AUM at 21% annually over the past 5 years. Going forward, we've modeled a conservative 13% AUM growth over the next 5 years. The growth in AUM will subsequently drive growth in management fees and carried interest, which ultimately create value for shareholders. Next, Dan will discuss driver number 4, our valuation.
In arriving at our target of $44, we separately value the two components of the company, its proprietary capital and its asset management business. We use a sum of the parts approach, applying a suitable methodology to each part. Onyx's private equity investments make up the largest component of the company's value. We value each item using a public company comparables approach. For Onyx's holdings that are publicly traded, we use analyst consensus target price. For the remainder of its proprietary capital, we value each holding at its current value plus an appropriate growth rate. Adding up all these components, we arrive at a projected NAV of $45.23 per share. Now, Onyx's shares historically trade at a discount to its NAV for two main reasons: an illiquidity discount on its operating companies and a control discount as the CEO, Jerry Schwartz, has voting control of the company. As you can see, this discount has been shrinking, as translating to greater returns for shareholders. However, for our valuation, we apply a fairly conservative discount based on the average over the last 2 years of 18% for Onyx's private holdings and 15% for its public holdings. Moving on to its asset management business, we value the management fee income that Onyx receives using a DCF approach. In projecting assets under management, we forecast gradually declining annual growth using an exponential decay model to reflect the fact that current high growth rates are likely not sustainable as the business gets larger. We also use a DCF approach to value carried interest. Now, unlike established asset managers such as Blackstone, we do not believe the value of carried interest is being fully priced in by the market for two reasons. Onyx's asset management business is fairly new, so carried interest received to date has been small. And, as you can see, historically, carried interest is volatile and difficult to predict. For this reason, we are only including 20% of its projected value into our target price. However, as assets under management continues to grow, carried interest will become a clear source of value to Onyx. And as this happens, the market will gradually price it in, offering an additional 11% upside to our target price. Now, Meng will discuss investment risks.
Succession risk is a major threat to the feasibility of our target price because Onyx performance relies heavily upon its human capital. The risk is that Onyx may not be able to successfully recruit new managers. Furthermore, Jerry Schwartz has been instrumental to the company's past success. If he steps down, Onyx may not be able to maintain its current performance. Another risk comes from Mr. Schwartz's multiple voting shares, which gives him 60% of the voting rights. If he ceases to hold these shares, the voting rights will be distributed to subordinate shareholders. Such drastic change in share structure can have two effects. It may increase share price as a result of reduction in control discount, which we've just discussed, but it can also decrease share price due to uncertainty associated with control decentralization. According to IMF, the U.S. economy is projected to grow at 1% in 2012. However, Europe is expected to fall into recession, and growth in developing countries continues to lose steam. These factors pose a risk to the expected U.S. recovery. According to our scenario analysis, a weaker than expected U.S. economy will revise our target price to $37.46. Valuation management fees and carried interest is based on the assumption of sustained growth in AUM. However, Onyx may not be able to achieve the assumed growth rate. The worst-case scenario of our sensitivity analysis yields a target price of $38.44. Despite these risks, we are confident that Onyx remains a good investment because of its strong management team, favorable economic conditions, growing asset management business, and undervalued shares. Together, these four drivers lead to our buy recommendation of $44.